On August 23, 2000, a single share of Enron traded at $90.75. 16 months later, that same share was worth about 26 cents. This is not the story of a company that lied about one number. It is the story of a company whose profit engine and its cover-up were built from the same parts. At its peak, Enron was the seventh largest company in the United States by revenue, carrying a market value of roughly $70 billion. Fortune magazine named it America's most innovative company 6 years running, from 1996 through 2001. Wall Street did not miss a fraud. It applauded the mechanism that was quietly consuming the firm. Here is the autopsy finding stated up front. Enron ran two machines. One manufactured reported profit. The other hid the losses that profit was not really covering. The fatal detail is that these were not two machines. They were one, and they were wired to the same power source, Enron's own share price. Start with the earnings engine, mark-to-market accounting. In January 1992, the SEC granted Enron permission to use fair value accounting for its energy trading contracts. On signing a 20-year supply deal, Enron could book the entire projected lifetime profit of that contract as present-day income, not the cash, the estimate. Understand what that does to a business. A contract can only be booked once. To show growth the next quarter, you need a bigger deal, then a bigger one after that, a treadmill that never slows. And because the profit was an estimate and not cash, reported earnings climbed while actual operating cash flow lagged far behind. That gap is the tell. But mark-to-market cuts both ways. If you can mark an investment up into earnings, you must mark it down when it falls. Enron held volatile stakes. The clearest example, an early investment of $10 million in a company called Rhythm's Net Connections that ballooned to roughly $300 million on paper. That gain now sat in earnings, exposed to reversal, and Enron could not sell to lock it in. A real trader hedges that exposure by buying a put from an independent bank. Enron instead built the counterparty itself. Chief Financial Officer Andrew Fastow created off-balance sheet partnerships, LJM1 and LJM2, named for his wife Lee and his sons Jeffrey and Matthew. Enron's board twice waived the company's own conflict of interest code so that its CFO could personally run the entities sitting across the table from him. In 2000, the structure was industrialized into 4 entities known as the Raptors, codenamed Talon, Timberwolf, Porcupine, and Bobcat. Their job was to absorb mark-to-market losses on Enron's merchant investments, but look at how they were capitalized. The Raptors were funded principally with Enron's own stock, and with contracts to deliver more of it. Read that plainly. Enron was hedging Enron's investments using Enron's share price. There was no independent party taking on the risk. One entity, Talon, carried a collar. If Enron stock fell below $81, Enron was obligated to feed capital into its own hedge counterparty. That is not insurance. That is a company promising to prop up its own safety net precisely as it starts to tear. This is the load-bearing mechanism, the part a trader feels in the gut. A hedge backed by your own stock has a hidden property. It fails exactly when you need it. If the underlying investment falls at the same time your share price falls, which is what happens in a market panic, the counterparty backing your hedge is insolvent at the very moment the claim comes due. The hedge and the thing being hedged were the same asset. Now watch the loop run. After Enron's stock peaked in early 2001, it began to slide. As it fell, the Raptors' capacity to pay Enron fell with it. By late March 2001, the 4 entities were roughly $504 million short of what they owed. Rather than book that charge, Enron papered the hole with 18 million more of its own shares, pouring more of the falling asset into a structure that was falling because of it. One investor read it in real time. Short seller Jim Chanos began betting against Enron in November 2000, working only from the public filings. His thesis was structural, not forensic. Enron was earning a return on capital of about 7% while its cost of capital was roughly 9%. It was destroying value while reporting growth, and its earnings wildly outran its cash. You did not need the fraud memo. The arithmetic was the short. October 16, 2001. The detonation. Enron reported a third-quarter net loss of $618 million. Separately, on the analyst call, it disclosed a $1.2 billion reduction in shareholders' equity tied to unwinding the Fastow entities. Note the distinction most retellings botch. The equity cut was not a loss on the income statement. It was the balance sheet admitting that stock booked as an asset had never been real value at all. And the man who built it profited enormously. On an October 23 board call, Fastow disclosed he had personally made about $45 million from the LJM Partnerships, for work he had reportedly described as taking 3 hours a week. He was removed as CFO the next day. He would later plead guilty to 2 counts of fraud and forfeit $23.8 million in assets. The confession came on November 8. Enron restated its earnings back to 1997, erasing roughly $586 million of previously reported net income and pulling the hidden entities back onto the books. The trigger in October had merely opened the door. The restatement showed the room was empty. November 28 was the kill shot. The 3 major rating agencies cut Enron to junk. That single-act trip triggers buried in Enron's structured debt, accelerating an estimated $4 billion in obligations at once. Worse, an investment-grade rating was a precondition to trade at all. Enron was a dealer, and a dealer's only real inventory is counterparty trust. Junk status was a margin call, a counterparty flight, and a liquidity freeze arriving in the same instant. A rival Dynegy had agreed days earlier to a rescue, a stock deal worth roughly $8 billion with an immediate $1.5 billion cash injection. When the downgrade hit, Dynegy walked. On December 2, 2001, Enron filed for Chapter 11 bankruptcy, listing $63.4 billion in assets, the largest corporate bankruptcy in American history at that moment. It held the record for about 7 months. The people who paid were not the architects. Roughly 4,000 employees at the Houston headquarters lost their jobs within days. And the retirement plan, with something close to 60% of its assets held in Enron stock, had been locked down during an administrative changeover, freezing employees out of selling while the shares cratered toward zero. They watched their savings evaporate through glass they could not break. The collapse took the auditor with it. Arthur Andersen, one of the 5 great accounting firms, had blessed the very structures it helped design. After the SEC inquiry became public, its Houston office shredded documents and deleted emails. Convicted of obstruction of justice on June 15, 2002, Andersen surrendered its license to audit public companies, erasing a firm of roughly 85,000 employees worldwide, the overwhelming majority of whom had nothing to do with Enron. There is a bitter coda. On May 31, 2005, the Supreme Court unanimously overturned Andersen's conviction, ruling the jury instructions defective. But vindication arrived years too late. The firm was already a corpse. The mechanism worth naming. It was the indictment, not the conviction, that killed it. Clients do not wait for a verdict. Out of the wreckage came the Sarbanes-Oxley Act of 2002, passed 423-3 in the House and 99-0 in the Senate. It ended the audit profession's self-regulation, forced chief executives to personally certify their financials, barred auditors from selling consulting to the clients they audit, and made destroying documents a federal crime. Nearly every provision is a direct answer to a specific thing Enron did. So read the autopsy one last time. Enron did not die of a bad quarter. It died because the machine that made its profit and the machine that hid its losses were the same machine, and that machine was collateralized with its own stock. In traders' terms, Enron had spent a decade selling puts on itself and booking the premium as income. The market it was betting against was its own reflection. When the reflection finally moved, there was no one on the other side of the trade.